Okay, well, we might, I think we might get started with the formal part of the presentation. So it's really nice that everyone made the time to come along today and listen to this inaugural Lunch with a Fundy presentation that we're putting on. I hope it goes well for us and that everyone enjoys it. We'll probably ask you for some feedback and ways that we could improve it, because I'd like to do this probably at least once a month with some of the fund managers and even some non-fund managers, some commentary from people that we know and respect. I think it's good to be able to have this sort of one-on-one feedback. You know, you get a lot more I think depth of conversation than what you get when you get just a fact sheet from a fund manager that's got a few things on it. And yeah, it's just been a good opportunity to use Zoom to widen out and invite some of our clients along to lunch with a very intelligent lady today. So we really appreciate Sarah taking the time to come along and spend a half an hour or more with us as well. So thanks, Sarah.
Many thanks for the invite. And look, from my perspective, it's the perfect time to be talking about infrastructure, given the high quality assets out there, very attractive valuations. And from my perspective, infrastructure is the winner of COVID. So I hope everyone enjoys the session, and I look forward to the questions.
Very good. All right. Oh, and I must congratulate you too on your upgraded recommendation with Lonsec, the independent researcher, which I know that a lot of financial planners rely on their opinions, and they've given an upgrade to the 4D Infrastructure Fund just yesterday, actually. So that was good news, and congratulations for the hard work that you've put in to get that.
Thanks very much. Yeah, we were really pleased to see the upgrade come through.
Yeah. Okay, so let's drill into a bit more of the detail for everyone listening in. If you want to tell us, Sarah, about the name of the business, how that came about, and also maybe a bit of info about your kind of pathway into the business. Everyone has their own story about how they got into whatever their profession is. So I'd love it if you could share a bit of that with us too.
Sure. Look, so regarding the first question and the name that is 4D Infrastructure, well, to be honest, I found naming a business is very hard. Particularly when it needs to be available globally. So the little bit of a saga to the 4D Infrastructure name may give you a little bit of an insight as well as how we are managing money. So we were originally called Four Corners Infrastructure, as we wanted to be recognised as the infrastructure fund looking at all four corners of the globe. Unfortunately, someone objected to that name, so we went back to the drawing board. Our second attempt was 4 Dimensions Infrastructure. We were really looking to incorporate the 4 dimensions of investing. So the reward, the risk, the cost and time. So everything that had to come together to provide your returns. Again, someone else objected to that name. And unfortunately, these objections always came at the last day of a copyright application. Right. So the process was becoming incredibly cumbersome and time consuming. So after hours of deliberation, we decided just to shorten the name to 4D Infrastructure and hopefully build a brand around that as opposed to the brand or the name creating our brand. But behind the scenes, I guess what we'd really like people to know is that we are investing in all four corners of the globe and to give our clients the best risk-adjusted return over the time frame or the investment cycle that we're looking for.
Right, so okay. And yeah, and your actual entry into kind of getting your interest in infrastructure and becoming an investment manager with infrastructure, how did that come about?
Yeah, it's a little bit sad to say you have a love for infrastructure, isn't it? But that has developed over time. So look, just in terms of my background, look, I've got close to 30 years in finance. I started as an accountant in my hometown of Newcastle before moving into commercial law in Sydney, where I quickly discovered that I like analysis, but not drafting, and I like numbers, not words. Right. So in 1998, I moved to London, where I spent 7 years working as an equity research analyst, and which combined my love of numbers with analysis, and I finally felt I had found a niche. And that's also where I really developed a love of infrastructure, the very defensive earnings and the predictability of earnings that is infrastructure very much appeal to an accountant. So I really found that place where I like the analysis, I like the markets, I like the asset class. However, ultimately I didn't like the weather in London, and in 2005 driven for a desire for blue sky and sunshine, I returned to Australia and joined Rare Infrastructure, which was one of the first listed infrastructure managers here in Australia. I was with them for 4 years as part of their investment committee, and I was also responsible for launching and managing the Rare EM strategy, Rare Emerging Market Infrastructure strategy. After my time there, I moved to AMP Capital Brookfield, two very big names in the infrastructure world, again as a portfolio manager, but then that JV split up, and it was at that point I decided, with my business partner, who you will be able to see on page 3 of the presentation if we want to pull up that slide, that this was the time that we wanted to look and launch 4D Infrastructure. So I'd been involved in the launch and the ramp up of 2 listed infrastructure managers. Greg had over 30 years in infrastructure across all gambits of the infrastructure world. So together we decided that with our view that things were only going to get more exciting within the infrastructure space, that it was now our time to go and build what we hope will be a best-in-class infrastructure manager.
Right, that's a good pathway. So those are things you'd put on your bio. Tell me something that's not on your bio. So tell me some secret about Sarah Shaw.
Well, look, I detest running, and I've never experienced a runner's endorphin in my life. Yet somehow I keep signing myself up for half marathons, and have never enjoyed a single minute of it. So the reason I flagged that today is because I'm sitting here looking outside, dreading the 42.2 kilometres that I am due to run this weekend, particularly given that the weather is supposed to be awful. So
right. Wow.
I'm not sure why I keep doing it.
I can relate to that. Also not having the runner's endorphin, because my theory is I've got a perfectly good car. Why would I need to run anywhere? But I'm sure you would get along well with our CEO of the financial planning, Peter Kirk, who is an avid runner, and Tony Marshall doesn't mind a run himself. So so you can compare notes with them.
Look, my notes are very slow. I think they'd be running loops around me, but it's all about it's all about the time on the feet, I've decided. Yeah.
Good stuff. All right, thanks for that. Hey, now regarding the business, can you tell us about the funds that you manage, and is it just the one fund? And talk about the total universe of all the investments that you've got to select from.
Sure. So look, we currently manage 2 funds, which are drawn from the one universe of investment opportunities. So our flagship fund is the Global Infrastructure Fund, which has up to from 0 to 40% exposure to emerging markets. The second fund we run is a pure emerging market infrastructure fund, which, as its name suggests, has 100% exposure to emerging markets. And the reason we have that second fund is that the emerging market infrastructure story is a thematic we remain really excited about, despite the recent sell-off. So in terms of how we come about our universe and how the opportunity set comes about, well, look, our investment philosophy at 4D is very simple, and it's really sort of broken down into page 4. But what we want to do is we want to give investors access to the best opportunities globally within the listed infrastructure space for whatever point of the market or economic cycle we are in. So to really understand this philosophy, if I can break it down, in terms of building our universe of opportunities, we start with the definition of infrastructure. So what is infrastructure? And put simply, infrastructure provides the basic services essential for communities to function and economies to prosper and grow. And this is sort of on page 5 of the presentation.
Okay, I'll just get Ryan to jump down to page 5 there.
Yeah. So 4D, this equates to the publicly listed owners and operators of what we classify as essential services. So these are your regulated utilities, like your gas, your power, your water providers. Mm-hmm. And then on the other hand, we have what we call user pay assets. And a user pay asset is something like a toll road, an airport, a port, a rail, some sort of communication infrastructure where you as the user will pay to use that asset. Now, all of these assets are characterized by monopolistic market positions or ones with very high barriers to entry. They have returns that are underpinned by regulation or contracts. There's very much a high upfront capital intensity to the investment, but then there's very low maintenance requirements going forward. They also have a largely fixed operating cost base. They have inflation hedges, which is a risk in investing. And so pretty much everything that comes together to give us as investors long-term, resilient and visible cash flows, which underpin a yield or a potential yield, so growth. Now, it's because of these characteristics that infrastructure is known as a defensive asset class with a lower volatility of earnings and a higher yield than broader equity. As an investor, I love these defensive characteristics. And so this is where we start. Our universe must have these defensive characteristics.
Right.
All stocks must have these defensive characteristics.
So just to divide those up again, the essential services,
Yes.
and the user pays asset. The user pays asset, like the airports and things, I'm guessing you would classify them as being much more cyclical than the essential services ones, which is your water, which everyone still turns the water on, or everyone still turns the lights on even when we're in a recession, right? Yeah?
Absolutely. And you'll see this on page 6 of the presentation. If we can just quickly jump to page 6, is you see this risk and the return profile. So the two areas that we really focus in on is those two middle areas. One is your lower risk, lower return regulated utilities or essential services. And these assets are immune to economic cycles. And this is a great part of infrastructure, is that you have these two very diverse subsectors. One's completely immune to economic cycles. These are the assets you want to be overweight to in depressed growth or the situation we're in today, to be honest. And then on the other hand, you have your user pays. Now, these are directly correlated to growth with an inflation hedge. So while you are getting those defensive characteristics, you're getting more in the economically sensitive infrastructure opportunity sets. So they're the assets you'd prefer to be exposed to in a more a more buoyant or a growth environment, which we have experienced over the last few years.
So could I just ask a question there? Something like AGL, so there must be some filters in your system that says, yeah, this company owns some infrastructure assets, but they're actually not primarily an infrastructure business, or they don't fit our criteria. Does AGL, for example, fit in an infrastructure?
No, it doesn't. It does not screen as infrastructure
Right.
for the very reason, and if you look at that chart that we have there, AGL fits more into the competitive assets. So AGL, so when we're looking at the infrastructure, we really want that regulated earnings stream or contracted so that we can see that visibility of the earnings profile. Now, AGL has some of that, and we need over 50% of operational EBITDA to be coming, so profits to be coming from those really resilient earning streams.
Yeah.
What we don't like is anything that's competitive. So if they've got energy retail or merchant generation or anything that is subject to the vagaries of the market or the commodity pricing or anything to do with economics. Now, a utility should not have an economic link, and for us, the AGL does not meet our criteria.
Right.
Whereas something like, by contrast, an APA here in the Australian market definitely does.
I was going to ask about that. That's the Australian Pipeline Trust. So it's
exactly
carrying gas all the time. Yep.
And it's all contracted or regulated. So
right.
It's got, it's got these huge pipeline networks with, monopoly positioning across Australia in terms of getting, commodities from A to B or gas from A to B. And all of their earnings are underpinned by contract with either take or pay or regulated returns. So you don't have the economic link to something like an APA that you would to an AGL.
Right. Great. Okay.
So at the starting point, that's our universe, that definition. And look, we get up to 300 infrastructure opportunities globally within that universe. So that's our starting point. We then, just to do with the rest of our philosophy, just very quickly to round that out, and it will come to your point a little bit more, is secondly, we are truly global. So we look at both the developed and the emerging markets for our opportunity set. We do believe emerging markets are way too important to continue to ignore. We are also something called index agnostic. Now, this is probably not so relevant for the people on the call, but what it means is that we are just investing in the best opportunities globally, not considering what size they are or where they're based or whether they're part of an index or how much of an index they make up. We want to give you the best opportunities, not something that's dictated by an index.
Right.
And finally, and this comes to your point about the positioning, is infrastructure as a defensive asset class can be positioned for all points of those economic cycles. So we very much actively manage between those essential services, economically immune, great overweight positions when the outlook is depressing, and then to user pays where we go overweight those GDP sensitive stocks when markets are buoyant, the growth outlook is great. You know, this is the recovery post the COVID. So COVID, the current environment is utilities, the future recovery is user pays, and active management between those two. So tilting between those two different subsectors will allow you to capitalize on the entire opportunity set, but smooth the volatility of the market cycles because those two economically diverse subsectors.
Yeah, we definitely like those defensive aspects of it, and we see that, you know, that hasn't changed from our perspective, and that's why it's in the portfolios. But probably what surprised us was the depth of the sell-off that we experienced.
Yeah.
Like I think peak to worst, we were down, or the 4D fund was down about 23 or something to that worst date in March.
Yes.
Do you have any kind of background on why we would see that level of sell-off, given that these are pretty defensive assets?
Yeah, so look, our view is that the March sell-off was indiscriminate. It was I think, and that's the one thing we have to keep in mind about listed infrastructure. It is an equity, and when the market goes, when there's something that happened like March and there's an indiscriminate sell-off, we will be caught up with it. There is definitely the volatility was extreme, and just to give you a couple of examples of, to your point, why these fundamentals shouldn't have been sold off. We had stocks that were under takeout, so the price had been locked in, and they were still down 30%. So It was a complete market exit, and we decided at that point in time that we didn't want to chase that market volatility. But what we did throughout that March period is we went away and stress tested our fundamentals within our stock, within our companies, to really say, look, are we right? Are they as resilient as we expect them to be? And because by stress testing or reviewing those in this period of volatility, what it did for us is just opened up this huge opportunity set. So we started April, so after the big sell-off, we've just spoilt for choice for stocks that had been completely oversold. Now, some of them, yes, will suffer a near-term earning impact, and they're the more user pays. But utilities, we're seeing it coming through in the results season at the moment. They're reiterating their full-year guidance. There's no earnings impact from COVID. They're reiterating their dividend policies, so their yield is even stronger now. So the fundamentals, these earnings fundamentals had proven to be infrastructure. So I guess the way I would play with it, the market volatility did not say defensive. The earnings fundamentals say defensive. And that's where the huge opportunity set now lies, when the market realizes that defensiveness and comes back to re-rate these stocks.
And in the long run, the price will come back to the earnings as long as the earnings are there. Yeah.
I have no hesitation saying that. I have no hesitation saying that if you were to buy infrastructure today, that in 2 to 3 years, you will have made a lot of money.
Yeah, that's what we like to hear. Yeah, look, I was going to say at this point, maybe if you wanted to drill down a little bit more into the kind of holdings that you've got in the portfolio, maybe some of the things you're excited about, or some of the things that are concerning at the moment, like when you were doing that stress testing, where you're finding certain assets that might have been overly geared. I guess the big thing that we've got as a wind behind us in this downturn is that central banks have been more than generous in making sure that there is adequate liquidity, and it doesn't even seem to matter where you sit in the credit stack. Even if you're double B rated and outside the investment universe, at least in the US, the Fed over there has said, you know, we've got your back, we'll support you, we'll buy your debt if nobody else will. So that to me is a big difference on the risk from the debt, because a lot of these businesses and industries obviously are supported with fairly high levels of gearing in some cases. Maybe you can correct me on that if I'm wrong about that. But yeah, so if you could drill into some of the specifics, because I think you also bought some Sydney Airport in the downturn or after the downturn at some point.
we have, Sydney Airport is on our trigger list, shall I say. So what I would say is, I'm going to see if I can break this down into two sections, if that's okay.
Sure.
In terms of, I'd really like to just very quickly touch on the structural opportunity that is infrastructure. So ignoring COVID, just really as a basis, as a starting point, and say, well, why are we excited about infrastructure as a structural opportunity? And then that would very nicely lead into the COVID-19 threat and opportunity, and why we see infrastructure as the winner of that COVID-19. So,
do you have a slide for that?
If you bear with me for a couple of minutes, I'll base it that way if I can.
Do you want us to move this presentation onto a particular slide number?
I am just having a look where I want you to. Yeah, so if we could move to page 8, I think that summarizes everything very well as a starting point. So this is the structural opportunity that is infrastructure. This is the opportunity that gets us excited as infrastructure investors, which I know sounds very sad. And it's a reason that the 4D business came into being, and it's the basis of all the thematics that we invest in as long-term investors. So look, we've discussed that infrastructure is defensive, but what we haven't talked about is that the huge growth opportunity that is available within the infrastructure space, which creates this really attractive thematic, which is intact despite what we're seeing in the COVID-19 environment. Now, this growth opportunity, this structural growth opportunity, is a result of decades of underspend within infrastructure, as well as the changing dynamics of the global population. So just to really quickly touch on each of these, and I'm going to put you to just, if we could jump down a slide as well, to the pictures. And the next one down, sorry. Yes, so look, there's been a chronic underspend on critical infrastructure in virtually every nation over the past 30 years, if not longer. And this really underspend has just been driven by governments having other spending priorities. So during the global financial crisis, the governments were focusing on bailing out banks, not replacing water mains. But what it means is that this spending is now critical. So just to put these, these pictures will show you, this is all developed market infrastructure in dire need of replacement. We have over 50% of London's water mains are over 100 years old. The Genoa Bridge collapse in Italy in 2018 highlighted the age of all of the European transport infrastructure, and it was just 51 years old. In America, which is our global superpower, close to 80% of the water pipes are over 30 years old, and some are over 100 years old. And that's wooden water pipes still being pulled out of the ground. And look, I'll bring it back to Australia, which is a piece of infrastructure very close to my heart. A train service between Sydney and the city of Newcastle, which is where I'm from, was launched in 1889. A premium service was launched in 1929, and it took about 2 hours 45. When it peaked, the fastest this trip was ever done was 2 hours 2 minutes in 1964. If I was to get on that train today, it would take me 2 hours and 55 minutes at best. Now, that is ridiculous that in this day and age, our infrastructure has gotten to such a place that we're actually deteriorating in terms of efficiencies. So this need to invest in developed market replacement infrastructure is huge. The next driver of the need for this infrastructure investment, and onto the next slide, please, is just global population growth. In 1900, we had a global population of 1.65 billion. It's now over close to 7 billion. Keeping in mind from that previous slide, we're still using infrastructure that was put in place for 1.65 billion. And so by the next century, we're looking at about 11 billion, which underpins yet even more spend. This population growth is also creating some environmental or climatic challenges, which underspin even more infrastructure spend if we want to keep the sustainability of the planet. Now, that's a thematic we can invest in as an infrastructure investor. And the final driver of this overall structural thematic, and the one I'm particularly excited about, and if we can move to the next slide, is the emergence of the middle class in developing economies, which is supporting both the emerging market domestic demand story, but also the demand for global infrastructure. Now, if you consider the size, the potential size of the middle class in emerging markets, with China, India, and Indonesia account for 40% of the global population, then changes in their spending and consumption is going to have huge ramifications for not only global business, but infrastructure investment. And that's going to be a theme for decades. We look at it from an individual's perspective. As your personal wealth increases, your consumption changes. Starts with 3 meals a day, moves to wanting clean water, indoor plumbing, gas for cooking and heating. That's all infrastructure. With power, you would then want fridges and TVs. That's logistics chains. And over time, you want to improve your efficiency. So you want roads to drive your car on or scooter. You want airports to expand your horizons. And so this is, I guess, one of the clear winners of this growth in the middle class is infrastructure investment. Now, you can invest in that by directly through the emerging markets, which we do, or even just through global investment by way of new and expanded airports. And I mention them in particular because of where the viewpoint on airports at the moment. But if you consider that only less than 10% of the Chinese population currently have a passport, then the airport thematic is structurally not broken. And I think we'll touch on that when we get to my comments on COVID. So if you put those factors together, and I'll move into COVID, but if you put those factors together, and that's the developed market replacement spend, the population growth requirements, as well as the emergence of the middle class, what is clear is the need for infrastructure investment is huge. What is also clear is that the traditional providers of that spend, be that governments, are not going to be able to fully fund this need, particularly post-COVID, where their balance sheets are stretched, supporting social aspects of the recovery. And this, quite hopefully leads into my second point, which is investing in infrastructure in a COVID-19 world. So, and how the opportunity set is now evolving. So look, we always maintain at 4D a diversified sector and regional portfolio, but at the moment we're tilting, we normally actively tilt between essential services or user pays, depending on that economic outlook. Now, the economic outlook is pretty ugly at the moment, there's no question. And so we're increasing our exposure, well, we have increased our exposure to the economically immune essential services. However, we have not sold out of the oversold user pay assets. And this you'll see on our strategic direction on page 13 of the presentation. So we are still invested in airports. We've actually added to airports during this crisis. As they are really fundamentally undervalued, and the travel thematic, which I've just discussed, is intact. We also think that once COVID-19 passes, it is an event, it will pass. It will have a significant economic and social hit over the next few quarters. We're not saying otherwise, but once you get past that, then you're into the post-war recovery phase, and that's where you'll see this stimulus that you mentioned, the stimulus, the government support, the economic stimulus really playing in and creating a recovery which will drive these user pay assets up towards their more fundamental true value. So we still are owning these ones that are offering really attractive value, although we have tilted towards more the utilities, which are giving you more of a yield support for the upcoming couple of quarters.
Right. Could you give us some examples you can name names if you wish to.
Yep.
Because I'm imagining that a lot of the things that you'd be buying would be in markets that are not in Australia. In fact, do you own any or many other than Sydney Airport? Do you own that now?
So the reality is Australia, coming into COVID, and look, Australia has a number of very high quality infrastructure names. Sydney Airport, Transurban, APA, all very high quality names, and they're all names that we have held in our portfolio. Coming into COVID, we could not find value in those names anymore. The quality was there, we just couldn't find the value. In the sell-off, clearly there's significant value there as well. From our perspective in the Australian market, we are comparing the Australian user pay assets now, which are definitely offering significant value, with their global peers. And at the moment, we remain, as I mentioned to you before, Sydney Airport is definitely on our watch list, and it's getting closer and closer. For me, below $5, it's just an unavoidable buy. And it's just too cheap then. The reality for me, though, in terms of, say, airport exposure, is that I have exposure to airports that are going to recover a bit faster than Sydney. And that is something like, as an example, AENA Airport, which runs the Spanish network of airports. Now, Europe is opening its borders to continental Europe, so within intra-Europe passengers, and they have a huge percentage of their passengers coming within Europe. So their rebound is faster than what we will see in other parts of the world. Other areas that we like, as an example, I own the Mexican airports. And the reason I own them, say over a Sydney right now, is that their regulatory model, so that the structure of their regulation allows them to reopen their model and adjust passenger forecasts if GDP falls below 5%, which it clearly will do in Mexico. So they get a rebalance very, very, very quickly to this passenger weakness. So while they'll take the short-term hit of the last few quarters, they won't take a hit going forward when that recovery is coming through, because their regulatory model adjusts to accommodate. Right. So,
and you've got exposure about 9% or something to airports at the moment?
Yeah, at least. So yes, it would be closer to 10, I would say, but yes. So that would be, we have 3 airports in Europe and we have 3 in Mexico. And as I said, you know, if Sydney's creeping back to that $5 mark, and clearly, you know, if I was a pure domestic Australian investor, you know, Sydney Airport's offering incredible value right now, but within a relative pick, considering we haven't been adding user pays, Sydney is still on the trigger list, but it's definitely, I would say, an expectation that it will make it into the portfolio.
Right. And within those more defensive assets, obviously yield is a big thing at the moment. The traditional yield plays that many Australian investors have had of banks are taking a haircut. What sort of yields come out of some of those more defensive plays at the moment?
Yeah, so look, to give you our overall portfolio yield, it's about 4 to 4.5% at the moment. Right. But in terms of the utilities, now this is very, again, it's a little bit fragmented based on regional locations. So the way to look at yield from a utility standpoint is that utilities get their earnings growth from investment. So the more CapEx you spend, or the more money you spend, the higher your earnings growth is. And that's just a structure of their regulatory environment. So they're encouraged to spend. However, the restriction on spending is something called rate shock, which means that the regulators won't let them spend too much that would see customer bills go up too fast, which would clearly create an issue from a social aspect. Yep. So their limitations on their spending budgets is called is by rate shock. So effectively, they spend as much as they can without rate shock, and then whatever they have left, they pay as a yield. So that's how the dynamic works, in particular in some of the utilities, because they can't spend any more, they're not allowed to, so they'll give it back to shareholders, and that creates the yield dynamic. In terms of the current environment, the US is still restricted a little bit from that rate shock. Europe, the utilities, we're still getting a 5-6% utility yield in Europe, but they're actually very much being encouraged to spend more as part of the recovery program. And this is the great thing about infrastructure, and this is where it's a winner of COVID-19, and that's across both user pays and utilities, is that for every $1 invested in infrastructure, you get a $3 to $6 economic impact. So you can understand why governments are so excited about increasing infrastructure investment as part of the economic recovery.
Yeah, absolutely. So, I think all of when we're talking to clients about, you know, what government is doing and what the various plans that they've got for restarting economies, I think it always turns to, we should be spending more money on infrastructure to build, you know, a better place long term, rather than, I know we've got to look after people socially, but rather than give them more money to spend at Harvey Norman, we should be allow that to happen, but after they've actually spent the money on, be it pipelines, roads, or whatever we need. Sorry to interrupt you there if you...
No, I was just going to say, you're exactly right. That's the 2 phases of government stimulus. The first immediate phase is social good. You know, it's the social support. The second phase, which is the part that gets the economy recovering, that's infrastructure. And so in terms of the yields, you just have to balance that with this potential recovery proposition, or this growth proposition, because Europe's announced the Green Deal, which is all about renewable energy growth, utility investment. Trump's talking about a $2 trillion infrastructure program, which is all going to see increased investment. So,
Yeah.
yes, you have still a very solid yield at the moment, which I know people are loving and require at the moment. You'll still get 4.5% out of the portfolio at the moment, even with a mix of non-dividend payers and dividend payers. But going forward, we really want to see them spend for future cash flows, future growth, particularly when the interest rate environment is so attractive.
And just something on that, because obviously, you know, if you pay out a dividend, that money's not there to reinvest. So with those regulated utilities, when they know that they're going to get X return on reinvested capital, then that's a compounding machine in itself anyway, isn't it? So
Exactly.
I think we can't just look at you know, the yields on those from a perspective of this has got a 3% yield and that's got a 4, so therefore
No.
it's better. Because if they're able to reinvest some of that free cash flow and then get what on it, 7 or 8%,
Yeah.
do they get those sort of numbers as a return on invested capital?
Absolutely. And so you will, so as an example, when we look at the US utilities, the yield is our secondary element we look at. The first thing we're looking at, or the first two things, are RAB growth, which is your asset growth, so your what drives your earnings growth, and then your EPS growth. So a mid-range utility in the US, so we're looking for at least 5 to 6% earnings growth from a utility in the US. If you're sub 5, then you're a low grow. If you're 8 to 9, you're a better one. So then if you take that earnings growth and then add their yield, that should be your overall return profile. So if you've got 4 or 5% growth and a 4% yield, say that's 8. These are very back of the envelope sort of assumptions. That's an 8%. If you've got an 8 to 9% EPS growth and a 3% yield, that's a 12%. So, you know, you've got to balance that that investment pipeline or that investment profile with the yield proposition, and you really want a mix of the two. You want someone, you clearly don't want someone that's over geared or got themselves into a debt problem, but we want someone that's investing for the future as well as supporting shareholders today.
Right. That's a great summary. I'm just looking at the clock and realizing that we've already been talking for 35 minutes, and I was going to do 25 or 30 and then ask some questions. So, Warren, have you had any people type in any questions into the chat bar? And or if not, maybe if you wanted to unmute or people, I'm not sure if you know how to raise your hand with the Zoom function, if you have any questions to ask. Are you on? No, you're off mute, Warren. Any questions in the queue there?
No questions in the queue at the moment.
No. Is anyone?
Mark, what I'll do is I'll allow people to unmute themselves if they've got a question.
Okay, thanks, Tony. So if anyone does have a question that they'd like to ask, if you just want to unmute yourself from the Zoom function, you'll be able to do that rather than unmuting everyone at once.
We're overwhelmed with information.
Anyone asking any questions there? Robert, do you have a question?
I think someone was trying to start coming through.
No. And is anyone else unmuted there? Just looking at my list here.
I might ask a question then while we're in. Sarah, thank you very much.
And then we'll take Anne after you, Tony. I think Anne's there in the queue as well.
Oh, Anne can go first.
Good afternoon. Look, I'm a bit of a novice with investment altogether, so that's why I leave it to the professionals. What percentage of investment is in Australia and what percentage is actually being put into overseas infrastructure?
Yeah, so at the moment we have 0% in Australia, and that's just to give you the background, the Australian listed infrastructure universe makes up about 2 to 3% of the global infrastructure universe. So Australia is a very small component of the listed infrastructure opportunity set. Unfortunately, that's a bit of a function that a lot of our assets are being taken over by others, but there is definite value here in Australia, and as I mentioned, Sydney Airport, Transurban, they're both contenders for the portfolio, and they have been top 10 positions for us historically, so we're certainly not anti-investing in Australia. It's just that we're looking at a very large opportunity set, and at the moment, the value proposition is favouring offshore.
Okay. Also, what about renewable energies? You know, since we are now thinking of a cleaner global environment,
Yes.
what sort of future investments are you looking at? Considering I'm heading towards 70, half of this stuff will be maybe in the pipeline. I probably will be dead. So I want to make some money before I die. So therefore, I want to know, for my granddaughter's sake, is she going to be able to feel proud that grandma did the right thing and invested in the right right infrastructure?
You know, I think, and that is a great question, because we often get the pushback that infrastructure is not green. Okay, that infrastructure creates, you know, we're building, we're emitting, we're not a green subsector. And my view is that look, the progress or the climate challenges that we currently face are impossible to fix without increased infrastructure investment. Infrastructure is going to be your solution to the decarbonisation or any environmental progress we need to make. And that's both at a utility level. Now, that's including your renewable energy. We have pure play renewable energy stocks in our portfolio. So they are wind, solar, hydro producers. We have utilities that are investing in strengthening the network to support renewables. One of our top 2 positions is the greenest utility in the world. It's called Iberdrola out of Spain. But I will also point to things like toll roads and airports and use of assets will be part of the solution. And the reason I say that is that they reduce congestion. They improve efficiencies, they improve quality of life. And without that, you're not going to get a greener world. So in that sense, I would say that your granddaughter should be incredibly proud that you are investing in infrastructure, because infrastructure is definitely the solution to climate challenges. And without it, we are not going to get to the decarbonisation targets that the world has set for us.
Okay. All right. Thank you for that. You can now move on to your next question, the next list. Thank you.
Tony, did you have something to add there?
Anne has stolen my thunder. So I was going to ask the exact same question about renewables and ethical investments. So thank you.
Okay, that's good. If anyone else has got anything, just raise your hand or come in there.
Mark and Sarah, I just got one. The Australian dollar is increasing, probably on the back of resources demand, and perhaps it's a reflection of the demise of the US dollar short term. What's the impact on the returns to your fund in regards to the dollar strength?
Yeah, so that's another great question. Look, we are an unhedged portfolio, and one of the reasons that we maintain that unhedged positioning is that the currencies can create a great deal of volatility. But if you go for a hedged portfolio, you have to carry a higher level of cash to support currency fluctuations. And we really just don't want to be in a position such as, and I'll use the example of the March shortfall, where we had a currency position that had to be met when stocks were very cheap. We didn't want to sell portfolio, and to your point, the Aussie dollar at the time was 58 cents to the US dollar. Extreme volatility. That's the last point in time where you want to have to do to be looking at your hedging positions. So we weather the volatility. What I would say is that we did not go and buy US dollar exposure when Australia dollar was 58 cents. Clearly, you can wipe out all your returns by trying to invest further in the US at those sort of levels. In terms of the Australian dollar today, I agree with you. I think it's a function of both the demand for commodities, which I don't see dissipating if you consider the amount of infrastructure that's going to be invested in globally, and also the weakness around the USD, which I think is partly due to the COVID situation in the US, as well as the election that is coming up in November. So we monitor the Australian US dollar clearly on a monthly basis. We don't invest against it, and it can offer us a tailwind or it can offer us a headwind, so we can add and we can detract. But what we have seen, and we can certainly share this with you, it's not in our pack unfortunately, but if you look at the return profiles of a hedged and an unhedged product over a cycle, you have the returns are very, very similar. You know, currencies tend to smooth each other out. The other aspect I would say is we invest in emerging markets, and if you believe in the emergence of the middle class, which is the thematic that we invest for, then emerging markets currencies will be a tailwind. They will improve your performance over the investment cycle. So we look at all currencies, both the emerging markets, the US dollar, and so forth. The other aspect I would say of the 4D fund relative to some of the peers is we are more overweight Europe and emerging market exposure than the US. So we are relatively underweight the US, and that is partly due to the political environment and the COVID situation over there. So yes, the US dollar has an impact on our performance, and it fluctuates. But we think the overall trend, or the overall volatility smooths out over the cycle, and it will have a limited impact on performance over 12 months, 2 years, 3 years.
Just something else that I wanted to just add in there on valuations too, Sarah, because I think we started off with you talking about the opportunity set that's in front of us with valuations coming down as they have, is to just contrast the listed valuations, which in some cases have come off 20 or 30%, versus the valuations that some unlisted, probably mostly within industry super funds, I think a lot of them reduced their unlisted valuations, and this is across a lot of unlisted assets, including property. They reduced those values by somewhere around 7 or 8%, you know, in about April, sort of, yeah, around about that period. And one of them, which is Hostplus, has since revalued back up by about 6 or 7%. So either one of two things happens, is their valuations are going to be a drag, or the listed valuations that are supporting the sort of things that are in the 4D fund are going to perform a lot better on a go-forward basis than those unlisted assets if they're still held at those old pre-COVID valuations.
Yeah, look, I have to say that I think the unlisted space has it correct this time. And I'll use maybe an airport as an example, if I may. And I think, to your point, I think this is part of the huge opportunity within listed infrastructure at the moment, is that valuation gap. Well, it's also a risk. I don't want to see the unlisted players coming and taking out my assets at depressed valuations, because they are offering such attractive value. But if I can take an airport as an example, so a couple of the unlisted revalued their airport exposure by, to your point, about 5 to 6%. Now, is that correct? And I believe it is. And why has then the market revalued airports by 30, 40, 50%? So look, let's be clear, the grounding of flights has an immediate impact on revenues. It has an immediate impact on earnings, and the earnings impact is greater than the revenue impact, because it's largely a high fixed cost business. Something we normally love, but in this environment where there's no movement at all, it's not a great place to be. So they're going to see a big earnings impact this year. And that earnings impact definitely deserves a valuation correction. There's no question. These values need to correct. But what should that valuation correction be? Now, if I'm looking at a Sydney airport, 77-year asset life. But if I'm looking at typical airports, 50, 60, 75-year asset life. They have a regulatory model that will rebase based on passenger weakness at some point in time. They will suffer near-term earnings impact as a result of the passenger shortfalls. But if you're looking at a 75-year plus asset, 1, 2, 3 year earnings impact, does that justify a 40% earnings impact, or a 40% value hit, or a 5% value hit? Now, I'm the view it justifies a 5% value hit. I also think that as we've discussed, the structural airport opportunity is intact. It hasn't. The people will come back. They will fly again. Memories are short. We will be traveling again at some point, and these passengers will come back. So in that sense, it may take 3 years to recover your passenger numbers, but the valuation adjustment that warrants is not 40%.
Mm. So I still make my case of buying the listed stuff. If you've got unlisted, sell it at that valuation, buy listed at this valuation and make up the difference.
Yeah, look, we always make the point that you're buying exactly the same assets. In some cases, type of asset, but in some cases, exactly the same assets. It's just how you access it. Did you access it, through the listed markets where you get liquidity and volatility, or do you access it through an illiquid vehicle? But you will pay more for that right now. And historically, there's been a value gap. Now it's a huge value gap.
Yeah.
And so we're definitely advocate of the infrastructure opportunity, and then a huge advocate of the listed infrastructure value.
It sounds like a great place to finish up, Sarah, because I'm aware of the time. It's 1:05. So unless there's any other questions, and we can certainly, if you think of something afterwards, send us an email, send it to your relationship manager, and we'll pass it on. And I'm sure Sarah will be gracious and give us an answer to whatever the question is. So,
Of course.
yeah. Thank you very much, Sarah, for spending this time with us, and thanks everyone for taking the time out of your lunch to attend. And we didn't even give you any lunch. All I've got is my bottle of Quill water, and I'm going to have a sandwich shortly. But hopefully you've had something to eat while we've had a chat. So thanks everyone for participation today. Thanks, Sarah.
Thanks very much for having me.
Pleasure. Looks like Warren's finished, so I'll end the meeting there. Thanks, Sarah. Thanks, Jody.
No worries. Thanks, guys.
Bye.
Thank you, guys. Have a great day.
Bye.
Bye.